Welcome back, investors. Today we are talking about Lumen Technologies. They are now in the penny stock territory. Personally, I typically stick to more blue chip stocks, those bigger companies that have long histories of good performance. But Lumen is one that has kind of interested me for a little while personally, not necessarily because it's a great value, but because I have some experience in the fiber optic broadband industry, and we've even worked with Lumen at one point, and so kind of an area I understand a little bit, and just wanted to dig into this company and understand it, and it's just really cheap, so definitely checking it out. But that to say, the company has been sitting under sub $2 primarily for the last few months. And there's a reason that it dropped from almost $16 in 2018 down to $1.65 just the other day. So we're going to dive into that during this video. Of course, if you're not really wanting to see all of the quantitative stuff, not really interested in that because, again, you can find most of that stuff out there. You can always, skip towards the end of the video towards the noteworthy stuff. This is more qualitative, stuff like competitive advantage, structure of the business, and mostly just stuff that I find in the 10K annual report that I think is worth knowing as someone considering buying shares. And so definitely, again, if you want to skip ahead to that, feel free. But I'm just going to go ahead and dive in. Again, price history, very steady decline over the last 5 years, and on a compounded annual growth rate about negative 20%, even farther when you consider where it's at now. But definitely in that penny stock territory. And, if you're an investor that's into kind of cigarette butt investing, Lumen might be one that you want to consider. There on the bottom right, cash per share, $1.14. So definitely getting in that territory where, the company may be worth more, even just in cash, than, the shares are costing. And if it got liquidated, good chance you'd get something out of it. There are caveats to that. And I'm going to cover a little bit about that, why that may not be the case anyways. Now, as far as governance, ISS scores, I do like to look at these just because it gives me an idea of not just how well the company is being run, but, how ethically. So audit score, board score, shareholder rights score, and compensation, all very positive, below 5, 1 to 10, and 1 being the best. So very good score there. Profit margin and return on equity, not good, negative about 10, negative 14, but operating margin and return on assets, healthy. So definitely some bright spots in this company, and as you'll see as we go through, there's definitely positives that I note here and there. There's a lot of negatives. Again, there's a reason it's trading where it's at, but that's for each investor to decide for themselves whether a company is worth investing in or not. And Lumen might be that company for you. Maybe you've already invested in it and you're just wanting to find out more. This is a good video for you then. As far as 5-year past and forward growth, negative 23% over the last 5 years, but they're projecting only a negative 1% decrease over the next 5 years. So analysts not really positive on the company, but I think there are some bright spots and possibilities. As far as operating cash flow, levered free cash flow, both very healthy numbers, right there in the billions of dollars. And that's what you want to see with any company. Now, as far as price earnings, also nice and low. It may be even lower. It's interesting that it does give a price earnings since it's primarily had negative earnings over the last few years. And, typically if there's negative earnings, it's a negative PE. Now, as far as PEG ratio, it's one of those interesting places where Yahoo Finance gives it 54, whereas Zacks has 0.1. 0.1 is obviously phenomenal because you want less than 1. And part of this just has to do with kind of how analysts are looking at the company, how much they think it's going to grow. So if they think it's not going to grow very much, then the price earnings does not justify it with the growth. Price to book, 0.16. Again, negative tangible book value. So interesting that it has a positive number, but definitely trading for a lot less than what the company might be worth. Price per sales 0.1, also very healthy. Usually I look for less than 2, and so way less than 1 is great. You'll see here that there's no future dividend, even though there's a past dividend. They cut that back November of 2022, I believe, and that's when the stock price really tanked. So again, there's usually a reason why the price is the way it is, and that was a big reason, I believe. However, and part of that's just a lot of people sell off when a dividend's cut, and for good reason. That usually means the company's in a very bad financial position. But in this case, they did bring in a new CEO in November of 2022, and she's been very committed, Kate Johnson, to increasing the bottom line, really getting the company back on track. And so cutting the dividend may have been the right decision in that case. So not necessarily going to fault them for that. Inside ownership healthy, over 1%. Again, cash per share $1.14. So going into working capital, current ratio, not great. There was a big divestiture in 2022, so the fact that it's still only above 1 is not good. Granted, 10.32% compounded annual growth rate over the last 5 years, so, hey, that's great, but again, it's well below 2, so I'm not a huge fan. They can pay their obligations, they just don't have a lot left over. Now, as far as cash generating power ratio, this, of course, is, if you're not familiar with it, looks at... It's a cash flow statement formula, and it looks at how much cash in the company is actually coming from operations and not from investing and financing. We want to look at how the company makes its money. And it looks like it's negative almost 19%. But the truth is, again, in 2022, there was a giant divestiture. So if you take that out of the ratio, you actually have almost 97%. You want a nice high ratio, so that tells you almost 98% of the company's cash that it generated was from operations, not from anything else. So that's really good. Tells you that they're not having to take on debt to finance it. Again, low inventory company because they're primarily focused on fiber optic internet, those kinds of things. So quick ratio just follows along with current ratio. Still not great. As far as the operating cash flow ratio, this is your cash from operations divided by your current liabilities. Not great. I give it a kind of an orange flag between green and red. And, steady decrease down to negative 5%. But actually sitting pretty high for a company in its state. So your cash from operations divided by your current liabilities, so they can meet just about everything just from running the business and not from having to continually take on debt. So pretty healthy position to be in. As far as capitalization goes, this is, financing, those kinds of things. And so debt level's pretty high. They, in terms of debt to equity, very high. You want to see less than 100% because that means, the number of dollars of debt for every dollar of equity. So lots of debt, but we're going to talk about that in a little bit because they are doing some things to improve the company in respect to that. Debt to assets, actually not terrible. 50 cents of debt for every dollar of assets. So, definitely in a positive position there. As far as assets to equity, very high. So that cause for concern there. Tangible book value per share, it's grayed out in the compounded annual growth rate. That's because it has a negative tangible book value per share. However, I will say it goes from negative $17.50 in 2018 up to negative $8.37 just this last year. So, take improvement where improvement's at. It has been decreasing the negative tangible book value per share. I apologize. A big part of a negative tangible book value per share is probably because the company does engage in a lot of acquisitions over the last, however many years. And so they probably have a lot of goodwill on the books. Hopefully they can engage in some goodwill impairment and get some of that off of there and get the numbers a little more trued up. As far as total debt, a big bright spot for this company, right? Negative 10% over the last 5 years. It's not all at once either. Steady decrease. It's a little bit at a time, and then it, is really just a big, push in the last couple years, dropping from 30 down to 20, when it only been dropping, 1 and then 1 and then 3 billion dollars. So definitely moving in the right direction there. Capital expenditure very steady over the last 5 years. That's something you want to see. They're constantly investing in the company and ensuring that it's not piling up on them. They have to suddenly come up with a lot of cash to invest back in the company. So steady at least. I apologize. As far as profitability, the company is doing well, but you look at your earnings per share, the diluted, all negative, except for 21. We need $1.91. So again, grayed out on the compounded annual growth rate. Doesn't work with negative to negative, but fairly steady at least. The company is where the company is, I suppose. Revenues have a steady decline over the last 5 years. Now, when I did do some digging, it's not its primary business that has seen the declines. It's primarily CenturyLink, which is a legacy-based copper broadband business out in, like Latin America and areas like that. And so, there are larger segments of the business, which I think are very valuable, continue to perform well. It's just some of these legacy programs they have do drag the company down a little bit. Now, in terms of gross profit, also pretty steady decline there. You do not want to see that. So again, there's a reason that it's a penny stock. There's a reason that the price has decreased over the last 5 years. Well, because the business hasn't necessarily made as much money in the last 5 years. And investors, we catch that. We see that, and that's not necessarily something we want to jump on board with. But again, there's still bright spots with this company. So don't think I'm bagging on it, especially if you've invested in it. Not bagging on you either. I'm just trying to look at just the numbers, right? So operating margin, pretty steady, right? Kind of goes back and forth a little bit, but overall, nice, healthy numbers there. And that's what you want to see. As far as return on assets, you also want to see a very steady increase, and we get that. 13% over the last 5 years. Really big jump in 2021, right? So definitely moving in the right place. Now, I will stop and say, right, we have a very positive increase in return on assets. Well, the reason I have that is because I use normalized net income and not just the net income on the income statement, because that's negative. So if we're using, regular net income, it's a negative value. So, definitely caveat there, right? I use normalized net income because Seeking Alpha offered it, because I wanted to see where it would be when we kind of adjust for some things. So definitely positive increase there, but you definitely want to look into what made them normalized to get rid of some of that negative percentages. Now moving into the qualitative side of things. So again, we've looked through these quantitative things and lots of pros and cons. Pros, I think, in some very good, meaningful places. Cash generation and debt management, capital expenditure, some margins. However, major downsides in some of those key ratios, right? Current ratio and debt, debt levels where they currently stand, and of course the tangible assets on the books, and the ability of the company to make money. So that to say, pros and cons, right? So going into some noteworthy factors, they have, this is something that I find very interesting. Now, I assume most people who are investing in Lumen know quite a bit about the internet, how it works, how our globe is connected. However, a lot of people don't know this. I was just talking to my wife the other day about it. And, in order to connect internet from like the US to Europe, there are actual hardline connections that run, across the ocean, across the seafloor. And so companies own that, right? And I can't remember how many total miles there are, but Lumen owns 25,000 miles of deep sea fiber, primarily running across the Atlantic Ocean. So that's worth something, right? That is not, chump change. That's not something that, another competitor can come along and just run line across the bottom of the Atlantic Ocean. It takes years and years to do that. And so those are some real tangible assets. Now, of course, the state of those things when they were run, those are things you might want to ask as an investor. They essentially run an internet highway on their wholesale side of the business, and we'll get into what that means in a second. But really, they engage in transmission of the internet. Not necessarily, they do some distribution. They do some generation. I work in both the electric industry and broadband. And so, I think in terms of generation, transmission, and then distribution, while they primarily do transmission and distribution, but they're engaged in some of the factors of generating what we know as the internet and its ability to function. Now, again, their new CEO came in 2022, so they've been transitioning the business direction. I think that's really positive for the company and something to note. There's a reason the company is where it's at, but there's also reasons why the company might be somewhere different tomorrow. The majority of the business doesn't derive from the declining CenturyLink segment. That's something important to know. There are some declining revenues. It's been steady. A big part of that is, copper lines are not good ways to transmit the internet. They never really have been, but in a lot of places, that's the best you can offer, right? It's steady, it's reliable to a point, it's easy to deploy, and it's usable. So, not the best, but definitely something that is phasing out as there's more options, every day. And again, this is one of the biggest things that I noticed in this company last year, and they brought in this new CEO. They've had different shakeups in the business, and they were able to eliminate $2.6 billion in debt in 2022. So big move in the right direction there. They have what's called dark fiber. This is fiber that a company owns, but they don't use it actively. And that allows them, other users who want to access this fiber, they can rent it, essentially. They rent the ability to send traffic through it. And they have quite a bit of excess of dark fiber. And so that's a really, really positive thing. That's recurring revenue off of an asset that's just sitting out there. They exist in a lot of developing markets. They exist in about 60 different countries around the globe. So a wide footprint. They have global infrastructure. They're a necessary company to an extent. There's a lot of other competitors, but ultimately the assets they own are important, real assets. Again, dividend cut in 2022 led to a steep decline in the share price performance. It signaled a challenging financial situation. And I know I've already said it too many times, but there's a reason that the shares are trading where they're trading. They did in 2022 have to pay $300 million to fully fund the shortfall in their pension plan. So something to look forward to. The only way I saw that was I read through the notes to the financial statements. That's why it's so important to read the 10K, read through things, because they eliminated that $2.6 billion in debt. Well, they did it with almost 2.4 million. Again, I'm going to get mixed up here, but essentially what was left over was what they were able to use to fund the pension plan. If you noted that graphic there at the beginning of the video, there's 450,000 miles of fiber. If you divide that by the span of the globe, which is about 29,000 miles, you can go around the globe 18 times with the miles of fiber that this company owns. They have underperformed their competition in price performance. Now, again, price performance, but not necessarily financial performance. And we'll look at that in a second. They, well, I'll look at it right now. So, again, price lagging, but they beat the sector, the median. So not necessarily the average, but median's more accurate when you're looking at a wide subset of data. And they beat the sector in gross profit margin. They beat the sector in EBIT margin. They beat the sector in levered free cash flow margin, return on total capital, and they beat the sector in CapEx per sales. So very good metrics there. They're generally profitable, but they do lag growth and momentum. I like looking at Zacks. I do trust a lot of their evaluation, and they actually give it an A in the value growth model. A for value, C for growth, and A for momentum. So, definitely positives there. Again, it can look dreary on the outside, but I think there are some upsides to this company. They also beat the sector in valuation metrics and in profitability. So, not all downsides, right? Wall Street is actually evenly spread on the ratings from, strong buy down to strong sell. There's no real consensus. And it seems like Wall Street itself doesn't know how to value the business. And so they end up all over the place. And that's a good place for a value investor, right? When Wall Street doesn't know what to think, you get in there and start digging around and figure it out for yourself. They operate in 3 different markets. The primary one is Lumen. That's their flagship. It serves the enterprise and wholesale markets, which is the most profitable. They have Quantum Fiber, which offers fiber services for residential and small businesses. They're really focused on investing in that one the last few years, and it's grown quite a bit. And then again, their main lagging market is CenturyLink, their legacy copper-based services. It's cheap, it's efficient, but it's kind of being phased out worldwide. Over the last few years, they've grown through acquisitions, and the new CEO seems to be pushing for them to, grow through actual business, not through acquisitions. Let's see. New CEO, I've talked about that. She created a North Star team, again, to sharpen the focus of the company. I think that's something that's been missing for the last 5 years. Of course, they have a large competition and it's growing. It includes system integrators, hyperscalers, cloud service providers, software networking companies, infrastructure companies, cable companies, wireless service providers, device providers, resellers, small niche providers. So, wide range of competition, but it's with what they do, there are high barriers to entry, I believe. And so I think there is still a degree of competitive advantage available to them if they can get focused. I talked about the divestiture. And so last year they sold their Latin American markets and ILEC business. And moving forward, they plan to divest their EMEA. It's their Middle East and Africa businesses, neither of which were seen as strategic shifts. And they'll get about $1.8 billion off the divestiture of the Middle East and Africa markets when they get that divestiture completed. They also repurchased 33 million shares of the company in 2022. Those were all fully retired, so that's good for investors as well. The shares that you do have, if they are, even if the price is low, are worth what they're worth. As far as audit matters, they have complex revenue structures, so the auditors obviously had to do some extra legwork, and then their goodwill impairment on the North American segments requires a lot of assumptions, and so that's always difficult for auditors as well. One of the bright spots, they have 20-year term IRUs, which are indefeasible rights of use. They're contracts that allow them to sell transmission capacity. You always want to see a nice long term on, leases and stuff. That means someone's really locked in, and that revenue is going to keep coming in. Now, when I mentioned, cigarette butt investors and people who might hope that if the company were to liquidate at some point, cash on hand and really what could be brought out of the company would be worth more than what you bought the company for. One thing to consider is a situation like this where preferred shares, if the company was liquidated, would receive $25 per share plus unpaid dividends if it was liquidated. So that to tell you, there's a lot of cash that would be going to, other people, other shareholders first. Because again, you got to pay all your creditors and debtors. And there's kind of a line order for who gets paid when. And so, people in the front of the line get the most. People at the end of the line, common shareholders, typically end up with the least, if nothing. And then again, $150 million net over the next 2 years. So not a lot each year, but then 1.7 billion comes up in 2025, and then about 17 billion from 2027 and after. So quite a bit of debt in there, but most of it's not coming up right now, and they've got some time to figure out what they're going to do with that. I don't want to go too much into this last part because we're about to wrap it up. But, a lot of competitors, if you wanted to look at some other companies to compare them to, Global Star, GSAT, Liberty Latin America, EchoStar Corporation, AST Space Mobile, and Cogent Communications Holdings are the ones that Seeking Alpha brings up. None of them really have great returns. Again, Lumen actually, despite its price performance, has beat them in value and profitability. Now, of course, common thoughts when you think about ISPs, internet service providers. A lot of people think about Starlink and other those alternatives like that. You also get concerned about line of sight services like Verizon and 5G and these kinds of things. But ultimately, what a lot of people don't realize is, again, there is a physical backbone to the internet. And, even if you're pinging it between satellites, that physical backbone sending data via light waves, the speed of light, is always going to be faster than having to ping it any other way. Typically, go watch the Hummingbird Project or something if you want to talk about line of sight services. But, overall, going from between continents and everything else, fiber optics is the way to go. So I hope you got something out of this. I hope you understand the company a little better. If you have questions, comments, concerns, definitely drop them in the comment section. I appreciate it, as always, if you'd like and subscribe so you don't miss out. Again, it also helps me, of course. But that's everything I've got on Lumen. I hope that you appreciate what I've been able to share. And as always, dig in, invest well, and I will see you next time.